in the last 1 month has outperformed all major
Leading
global
the
economies.
pack, outperforming the pack.
Nifty is up somewhere around 7%, whereas Dow and S&P 500, they are up somewhere around 5 to 7%. Stocks 600, the pan-European index is up about 7% or so. Shanghai Composite, China's index, is down by about 3%. And Nikkei has added by about 0.21% in the last 1 month.
All right, last 1 month, Nifty continues to be the outperformer. Rohit Srivastava, founder and market strategist, India Chart, on the show with us. Rohit, good afternoon. Thank you for taking time out. Nifty continues to be the outperformer, not just over the month, but today and yesterday. The momentum is continuing. Is it still the exuberance over what has happened as far as the 5 state elections is concerned? Is it the broader factors? What are you attributing this bull run to?
Surely the last 2 days action has to be attributed to the outcome of the elections themselves. But to some extent, we can also say that the markets started to anticipate this a while back, because we were really stuck at that 19,850 level. And the moment we got past that, it's starting to look like it was an anticipatory rally that started. And once the things really played out, you saw the big spurt and gap that we actually saw on Monday. But yes, the last 2 days are just associated with that. It will now be time to take one step back and try to look at the picture on a broader scale, on how we are really supposed to go ahead from here for the weeks or months to come.
All right. So now we were just talking about how Nifty has outperformed global equities in the last 1 month, and a lot of these factors have turned positive for not just us but emerging markets on the whole. Do you expect India's outperformance to continue in the next medium to short term?
So I do think India remains an outperforming market, but we do go both ways. I mean, if there is a significant issue in global markets, any kind of reaction for some particular reason, for example, the most anticipated US recession actually becomes a reality, then our market does tend to fall also more than other markets, as has historically been seen in that environment, which is what you really have to always be aware of when we consider global risks at any point of time. But yes, right now, those risks have abated and you're actually seeing us outperform on the upside.
And is that outperformance likely to continue? I think just building on to what Suyash was asking, given that global risks sort of have been put a pause to for now, all indicators looking very positive. The idea of a recession in the US has somehow been paused with your favorable sort of data coming in. So given what is playing out globally, as well as the macroeconomic indicators of a higher GDP, faster consumption, continuity in policy perhaps owing to BJP's thumping victory in the 3 states out of the 5 that went to poll, perhaps a reflection of what could happen in the year to come as far as general elections is concerned. What's your medium to long-term view on the markets?
No, I won't jump to a very big conclusion on this because, even if you consider global risks, there is a slowdown in parts of the US economy, which we can actually see in the data. It's just that the markets have done much better. So the markets are actually moving on what we call as sentiment. Sentiment meaning the positioning of people in the market. So if most people were actually pessimistic of what is going to happen in equities, we actually had a lot of short position built up, specifically say in India. If you just look at the data at the start of November, when we were at 18,850, then you actually had FIs built up almost the second highest short position on record at 176,000 contracts net. So when you look at that kind of short position, we were anticipating a short covering. The only thing is we halted at 19,850 for a while. I thought maybe we want to go past that. But the funny thing is that the shorts were actually not getting covered even at the end of November, and a lot of the cutting has actually happened post expiration in the early part of December, which means in the anticipation of this particular news item around the elections. I think that has caused a lot of the cutting. But even then, at the end of yesterday, which was the big day, you still have a day where shorts were at minus 25,000 contracts, so significantly down, but still short, still not gone back to the long side. And on the other side, even the client and pro positionings were ending up at the short. So if you actually add it all up together, you're looking at 35 to 40,000 contracts short overall across participants, which is still the higher end of the range in terms of having an overall short build up. So that is, I think, still allows you for a case that this market can extend higher because we've really not completed the process of getting those shots out of the way.
Now, so you were talking about global risk and how some of the data coming out from US is softer than expected. But with inflation being their biggest problem, it looks like bad news, which in this case a softer data, is actually a good news, because then it leaves door open for a rate cut in the next few policy meets. Wouldn't you say so?
Which is looking likely on the basis of the commentary that is coming in, perhaps in the first quarter of the financial year, US financial year, which starts January. On the back of that, what are the risks associated with inflation as well as recession? You said that there are risks of recession in certain parts.
Yeah, so it's let's not just take it as a given because some of the inflation data came favorable. There are issues with the most recent reading itself. But having said that, let's just look at what is causing growth, right? So you have one side, you have weakening inflation, which would actually be reflective of, well, that means that the overheated economy is actually cooling off. But on the other side, you have a 4.2% GDP growth print. So why is this deviation really happening? And the reason is that on the one side, you have a Fed which is trying to tighten by quantitative tightening and by raising interest rates. And on the other side, you have a rising government spend over the last 2-3 quarters. And that spending is essentially the one that is keeping the economy boosted and the markets afloat. So that is the risk of overheating, that's really coming from government spending, which is why you can't really write off the idea that inflation can have some kind of tailwinds and can show some kind of a bump up at some point of time. Are we really done with it? So unless we really see it clear out, we won't be able to say that it's really done. There's an experience that you have from the 1970s where inflation actually dropped a lot. The Fed got comfortable. They actually cut rates, and then it rebounded very sharply all the way up, and then they had to chase it all over again. So that is the risk that we face in a situation where government is spending relentlessly to keep growth going at the same time that the Fed is tightening, and then you wonder which one is really going to give in this situation. And so everybody's taking a bet based on just what the market is doing, right? If the market goes up, you start believing that the Fed is winning the inflation fight, and if the market goes down, you probably feel that they tighten too much. But since you have these two contradictory forces, we really don't know how it's going to end.
So just to clarify, you do not expect the sharp aggressive cut that the market is factoring in of about 75 basis to 100 basis points over the course of next 6 to 7 months?
Yeah, I will not take it as a given. I will say let us actually see it start happening. Unless the Fed actually signals that they are going to cut rates or that we are done and this is over, I will not buy it. And right now, they are not saying anything of that nature. If you look at their commentary from meeting to meeting, they're still saying that we need to keep it higher for longer and need to keep an additional rate hike on the table. For all you know, they will probably repeat the same thing at their meeting next week. And you need to watch out for that because you'd end up over expecting things without the data really helping us.
Okay.
And now, sir, the FII flows have once again picked up. They are back to Indian markets and back in a big way. They have bought in equities worth about 3,000 crores in the last 2 sessions. And China, Moody's has downgraded China's outlook from stable to negative. Given that this downgrade, do you expect the flows that were going to China that were expected to go to China because of this risk on sentiment, some of it to come to India?
So that's something we've tried to anticipate for all of 2023, and it's really not happened. Because if that was true, a lot of flows should have already come away from China to India. China has been slowing down for quite a while, and India has been outperforming in terms of growth, not just on GDP, but actual earnings numbers. But it has still not attracted, funds despite that happening. So I'm sure that the reasons are slightly different. Also, a lot of global asset allocation happens on things like simply using something like an MSCI emerging market fund or some allocation that they're making. People don't always specifically do an India allocation. they do an emerging markets allocation, and some of the money ends up coming here. At the most, what you end up getting is, okay, somebody reduces the weightage for China or some other places and increases the weightage towards India. And to that extent, yes, we should get incremental, flows. But for some reason, India hasn't really been receiving the kind of flows that we should have given our growth and outperformance.